A day of reckoning. The Indian stock market experienced a dramatic crash on April 7, 2025. It was the worst single-day fall since June 2025. The Sensex, a key indicator of the market, plummeted by a staggering 3,219 points. This represents a significant drop of 4.27%. The Nifty, another major index, also suffered a substantial decline, tumbling by 1,146 points, a 5% decrease. This crash wiped out 19.4 Lakh Crore rupees from the market capitalization on BSE. Investors were left reeling from the sudden and sharp decline. The magnitude of the crash sent shockwaves throughout the financial world. It served as a stark reminder of the inherent volatility of the stock market. The speed and severity of the decline left many investors questioning their investment strategies. The crash highlighted the importance of diversification and risk management. The crash also raised concerns about the overall health of the Indian economy. While the stock market is not a perfect reflection of the economy, it does provide insights into investor sentiment. The sharp decline suggested a lack of confidence in the future prospects of the Indian economy. This raised fears of a potential slowdown in economic growth. Shockwaves across industries. The impact of the stock market crash was felt across all sectors of the Indian economy. However, some sectors were hit harder than others. The Nifty Metal Index experienced the most significant decline, plummeting by 8%. This was largely due to concerns about the impact of a global economic slowdown on demand for metals. The Nifty IT Index also suffered a substantial blow, falling by 7%. This was attributed to fears of reduced IT spending by businesses in a recessionary environment. Other sectors that experienced significant declines included Nifty Auto, Realty, and Oil and Gas, all of which fell by over 5%. The automobile industry was impacted by concerns about declining consumer demand due to economic uncertainty. The real estate sector was affected by fears of a slowdown in the housing market, while the oil and gas sector was hit by the plunge in global commodity prices. The crash also had a significant impact on small-cap and mid-cap stocks. The small-cap index plummeted by 10%, while the mid-cap index fell by 7.3%. This was because these companies are generally considered to be riskier investments, and investors tend to shy away from risk during times of market turmoil. The broad-based nature of the decline highlighted the interconnectedness of various sectors within the Indian economy. The Nasdaq bear market. On April 4, 2025, the Nasdaq, a major U.S. stock index heavily weighted towards technology companies, entered a bear market. This means that the index had fallen by over 20% from its recent peak. The Nasdaq's decline was triggered by a number of factors, including concerns about rising interest rates, inflation, and slowing economic growth. However, the most significant factor was the announcement of new tariffs on Chinese goods by U.S. President Trump. The tariffs were seen as a major escalation of the trade war between the U.S. and China. Investors feared that the tariffs would lead to higher prices for consumers, reduced corporate profits, and a slowdown in global economic growth. The Nasdaq's bear market sent shockwaves through global financial markets. It served as a warning sign that the global economy was heading for a downturn. Investors around the world reacted by selling off their stock holdings, leading to sharp declines in stock markets across Asia, Europe, and the U.S. The Nasdaq's decline was particularly concerning because it is home to many of the world's largest and most innovative technology companies. These companies are seen as bellwethers for the global economy. Their decline suggested that the global economy was facing significant headwinds. The Nasdaq's bear market was a harbinger of the global stock market turmoil that was to follow. A world in freefall. The Nasdaq's bear market triggered a global sell-off in stock markets. Investors around the world, spooked by the prospect of a trade war between the world's two largest economies, began selling off their stock holdings. This led to sharp declines in major stock indexes across Asia, Europe, and the US. The sell-off was particularly pronounced in emerging markets, which are seen as riskier investments. The global sell-off was fueled by a number of factors. Firstly, the trade war between the US and China created a great deal of uncertainty in the global economy. Businesses were unsure about how the tariffs would impact their supply chains and profits. Consumers were concerned about rising prices. This uncertainty led to a decline in business and consumer confidence, which further weighed on economic growth. Secondly, the global sell-off was exacerbated by the increasing use of algorithms and high-frequency trading in financial markets. These computer programs are designed to buy and sell stocks based on preset parameters. When stock prices begin to fall, these programs can automatically sell off holdings, which can accelerate the decline in stock prices. This can create a snowball effect, where selling begets more selling, leading to a sharp and sudden market crash. Section 5. Recession fears grip investors, a looming threat to economic growth. As the stock market plunged, fears of a global recession began to grip investors. A recession is generally defined as 2 consecutive quarters of negative economic growth. There were a number of factors that contributed to these fears. Firstly, the trade war between the United States and China was already having a negative impact on global economic growth. The tariffs were disrupting global supply chains and increasing costs for businesses. This was leading to reduced business investment and slower economic growth. Secondly, central banks around the world were starting to raise interest rates. For the past decade, central banks had kept interest rates at historically low levels in an effort to stimulate economic growth. However, with inflation starting to rise, central banks were being forced to raise interest rates to keep inflation in check. Higher interest rates make it more expensive for businesses to borrow money and invest, which can slow economic growth. Thirdly, there were growing concerns about the levels of debt in the global economy. Governments, businesses, and consumers had taken on record levels of debt in recent years, taking advantage of low interest rates. However, with interest rates rising, servicing this debt was becoming increasingly expensive. This was leading to concerns about a potential wave of defaults which could trigger a financial crisis and a recession. Section 6. Commodities crash, demand concerns send prices tumbling. The global stock market crash and recession fears had a ripple effect on commodity markets. Commodities are raw materials or primary agricultural products that can be bought and sold, such as crude oil, gold, and wheat. The prices of commodities are heavily influenced by global economic growth. When the economy is growing, demand for commodities tends to be high, which pushes prices up. However, when the economy slows down, demand for commodities falls, leading to lower prices. The price of Brent crude oil, a global benchmark for oil prices, fell sharply. This was due to concerns that a global economic slowdown would lead to reduced demand for oil. The price of West Texas Intermediate, or WTI, crude oil, the U.S. benchmark, also fell sharply. Gold, often seen as a safe haven asset during times of economic uncertainty, initially rose in price as investors sought safety. However, as the sell-off in stock markets intensified, even the price of gold began to decline. Industrial metals such as copper, zinc, and aluminum also experienced sharp declines in price. These metals are used extensively in manufacturing and construction. The decline in their prices reflected concerns about slowing economic growth and reduced demand from these sectors. The commodity price plunge further highlighted the interconnectedness of global markets and the widespread impact of the stock market crash. Section 7. Seeking refuge flight to safety signals. Investor anxiety. As the stock market crashed and recession fears mounted, investors sought refuge in safe haven assets. These are assets that are considered to be less risky during times of economic uncertainty. One of the most popular safe haven assets is U.S. Treasury bonds. These bonds are issued by the U.S. government and are considered to be extremely safe because they are backed by the full faith and credit of the U.S. government. As demand for U.S. Treasury bonds increased, their prices rose and their yields fell. The Japanese yen is another asset that is often seen as a safe haven during times of market turmoil. The yen is considered to be a safe haven because Japan has a large current account surplus and a large net international investment position. This means that Japan is a net lender to the rest of the world and is less vulnerable to global economic shocks. As a result, the yen tends to appreciate in value during times of risk aversion. The Swiss franc is another currency that is often seen as a safe haven. Switzerland is known for its political and economic stability, as well as its strong banking system. As a result, the Swiss franc tends to appreciate in value during times of global uncertainty. The flight to safety signaled the high level of anxiety among investors. They were reducing their exposure to risk and seeking assets that were perceived as being less volatile and more likely to hold their value in a downturn. Section 8. Trade war escalation, a catalyst for market uncertainty. The trade war between the US and China was a major catalyst for the global stock market crash. The trade war began in 2024 when the Trump administration imposed tariffs on billions of dollars worth of Chinese goods. China retaliated with tariffs of its own on US goods. The tariffs were intended to protect US jobs and industries from what the Trump administration saw as unfair Chinese trade practices. However, the tariffs backfired. They raised prices for consumers and businesses in both countries, and they disrupted global supply chains. The tariffs also created a great deal of uncertainty in the global economy, as businesses were unsure about how the trade war would play out. The trade war escalated in 2025 when the Trump administration announced new tariffs on Chinese goods. China responded with retaliatory tariffs on US goods. The escalation of the trade war further rattled global markets. Investors feared that the trade war would spiral out of control, leading to a full-blown trade war between the world's two largest economies. This would have a devastating impact on the global economy. The trade war highlighted the risks of protectionist trade policies. Section 9. Navigating the Storm Expert Advice for Cautious Investors. In the wake of the stock market crash, investors were left wondering how to navigate the turbulent market conditions. Dr. V.K. Vijayakumar, the chief investment strategist at Geojit Financial Services, advised investors to adopt a wait-and-watch approach. He cautioned against panic selling, noting that this is not the time to take any hasty decisions. Dr. Vijayakumar emphasized the importance of staying calm and assessing the situation rationally. He pointed out that the market is currently driven by fear and uncertainty, which is leading to irrational behavior. Dr. Vijayakumar's advice highlighted the importance of taking a long-term perspective when investing in the stock market. He reminded investors that the market is cyclical, and what goes down must come up. He suggested that investors use this period of volatility to reevaluate their portfolios and ensure that they are well diversified. Diversification is a risk management strategy that involves investing in a variety of assets, such as stocks, bonds, and real estate. The goal of diversification is to reduce the overall risk of a portfolio. When one asset class is performing poorly, other asset classes may be performing well, which can help to offset losses.